Oh, the good life. Just retired with a gold watch and a nice fat monthly pension check, not a care in the world. Wait a minute. For over 90% of you watching, you're not going to get a pension check. If you want to be like Bob here, it's going to be all your responsibility. So you better learn the basics of investing. Are you ready to get started? Personal Finance FYI starts now. Hi, welcome back. I'm James Daniel, and this is Personal Finance FYI. A generation ago, workers could count on a pension check to cover a substantial amount of their retirement needs. But today, pensions have gone away, and they've been replaced by 401ks, which means that you are 100% responsible for your own retirement. The reality is, it's all up to you to save and invest, since your employer isn't going to do it for you. So with that in mind, on today's broadcast, we are dropping back and talking about the basics. Stocks, bonds, mutual funds, and ETFs, or what I like to call what they don't teach you in school. Today's broadcast can be thought of as sort of laying the foundation. In future episodes, I'll teach you how to apply what you learned today to become a better investor overall. So let me ask you, what exactly is a stock? Okay, time's up. A stock, or share of stock more specifically, is simply ownership in a business. If you happen to own a small business that is incorporated, you own 100% of the shares of stock in that company. As larger companies grow and are looking for ways to raise some cash for that growth, they can list shares of their stock on a public exchange, what we typically refer to as the stock market. This would be the iconic New York Stock Exchange or the NASDAQ. Normally the new shares are issued in an IPO, but most of the time you and I buy in the secondary market after the IPO on one of the exchanges I just mentioned. As an investor, you can buy these individual company shares on exchanges, and you hope that the companies will continue to grow and pay dividends to the shareholders, which will make the shares of stock more valuable. Typically, we view stocks as the growth part of your portfolio that will keep up and even exceed inflation. But stocks have risk, that they may go down as well as up, all based on the company's performance and market conditions. And that is why you diversify your investments, so that you are taking an acceptable amount of risk for the longer term growth that you're trying to achieve. Next on our list is a bond. A bond, also referred to as fixed income investing, is another way for companies or governments to raise money and another way for you to invest. But the difference between a bond and a stock is that the bond is basically a long-term loan, and you, the investor, are playing banker versus being an owner of the company with shares of stock. When you invest in a bond, you loan the company money by purchasing the bond, and in return you are promised a fixed interest payment annually for a certain number of years until the bond is redeemed and you get your investment back. A bond is strictly an income type investment, and you don't typically benefit in any overall company growth. In other words, if the company doubles the sales, the price of stock could go way up, but it would have little to no effect on the value of the bond. What does affect the value of the bond is underlying interest rates. So you often hear the talking heads on TV say something about the Fed raising or lowering the rates, which has an effect on bond prices. Bonds typically do well when interest rates are falling. Bonds issued by the U.S. government and highly rated companies are referred to as investment grade bonds. Bonds issued by lower rated, more risky companies are referred to as high yield or junk bonds. And bonds issued by states, counties, and cities are referred to as municipal bonds, and their income is typically tax-free for the investor. So the more highly rated you are, the less you have to pay investors in interest, because there isn't as much risk of loss to the investor. So let's think about this for a moment. Both a stock and a bond are ways you can invest. By purchasing stock, you're investing for longer term growth of a company as a shareholder, but purchasing bonds, you get a promised interest payment for income, but you don't participate in any growth. Keep in mind that our explanations have been simplified a bit, so you don't directly purchase stocks or bonds from the underlying company, but on what we call the secondary markets, the New York Stock Exchange or the NASDAQ. But in general, the idea is still the same. Does this make sense? When we come back, we will discuss the investment vehicle most of you are familiar with through your 401ks, and that is the mutual fund. On a side note, if you want to download a guide that explains All of these terms in more detail, visit theadvisoryfirm.net and click on the Investment Jargon Explained link right there and download your free copy. So what do you do if you don't feel like researching which stocks or bonds to buy in your portfolio? You do like the majority of investors and you invest in a mutual fund or its cousin, the ETF. Both of these products are investing vehicles that hold a basket of many stocks or bonds that are selected by the fund manager and allow you an easy way to invest without all the research. You simply buy shares of the mutual fund and have a percentage ownership in all the underlying stocks that the fund owns. Inside your 401k, you probably have many mutual fund choices with names like large cap growth or small cap value or even global income. The idea being that you can mix a certain percentage of stock funds with a certain percentage of bond funds for a portfolio that meets your risk tolerance, both growth and income. Typically, a mutual fund can be actively managed, which means the fund manager is hand selecting the stocks inside the fund to try and outperform its peers. Or it can be passively managed, which means that it is designed to track an index, like the S&P 500. Lastly, we will end today with a quick overview of the ETF or exchange traded fund. These are a cousin to the mutual fund, but they trade like a stock on the exchanges throughout the day and typically track an index like the passively managed mutual fund. While you don't see a lot of 401k plans with ETFs, you will find them very prevalent at any custodian that holds your IRA or brokerage account. Think of an ETF as an index tracking mutual fund if that helps. The reason for their popularity is they're very liquid, they trade throughout the day and have low expense ratios, and there's no minimum investment requirement. So today we reviewed the basics of stocks, bonds, mutual funds, and ETFs, and hopefully this reinforced some of the prior knowledge you had and has made you a little more comfortable and much less intimidated with some of these financial terms. I would like to thank you for joining me for this broadcast of Personal Finance FYI. I'm James Daniel, and I will see you next month.